So on this episode, Colin, it's super interesting. We've got Thomas Plagemann. He's the CEO of Clearlight Solar. Thomas has so much terrific experience in the industry. He worked at Deutsche Bank. He worked at First Solar. He worked at Vivint. He worked at Posigen, GE. He just has these amazing brands in his on his resume, all working in finance. And what he's built at ClearPath is a really interesting finance solution in the residential solar space. So super exciting to have him on the show today.
Yeah, and we're in an interesting time, obviously, for the resi solar sector in particular, with sort of policy change at all levels. And I think it's easy, I think, in this industry to get sort of caught up in all these machinations around how policy is affecting us. And what I appreciate about Thomas's conversation is that it really grounds us in like what we're actually trying to do, the products that we're trying to sell and provide to customers, and what they are looking for out of these deals. Like a customer wants a reasonable rate of return. They want expectations around, the performance of the system that they're going to install. And he's sort of built this business that's designed to meet that need of like actually pairing the needs of the customer with the needs of the company. And so, it gets jargony pretty quick. So I hope people can stick with us and sort of navigate the ins and outs of the finance world. I know I'm no expert, but it's just helpful to sort of have that frame of mind of how do we use this sort of policy transition to actually focus on sort of customer first approach.
100%. And at the end of the day, my biggest takeaway from this recording is that Thomas is optimistic about the future of the renewable energy industry. And when you work in finance, optimism is a great thing to have. So folks should listen in.
Thanks for having me on the show. Is it a regular show? I'm going to have to start tuning in. But thanks for having me and giving me an opportunity to talk to you about one of my favorite topics, residential solar. My background, which is relevant because it actually informs a lot of my views on the residential space, in particular, how to run a business, financing residential solar, what matters to the customer, et cetera. Started out in banking. I was a project finance banker for 10 years in the 90s. So I've been financing power generation for over 30 years. At that time, it was largely gas-fired power plants. It was sort of pre-Enron and then sort of going into the post-Enron era. For those who can remember those days, I shifted from Deutsche Bank into more of an equity-like role at GE in their structured finance group, and then eventually I was at AIG doing something similar. But I really moved down the capital stack. So started out as a lender and then increasingly moved down the capital stack and started doing more principal-like investing, direct equity investments in power plants, as well as structured tax investing, i.e., where we, either GE or AIG after that, were a taxpayer. We'd invest in assets and we'd monetize the tax value for developers who weren't taxpayers and couldn't do anything with tax credits or depreciation. And then starting in about 2006, 2007, I moved into renewables and been doing renewables ever since. For the first 5 to 7 years, I was doing utility scale. I started out really focusing almost exclusively on solar when I took a job at First Solar, where I ran their project finance team. Back in the early days when financing large-scale utility solar was something brand new, was very exciting. I did see the potential in solar. I used to always say, I love solar because there's no moving parts. It's something I've heard a lot since. But there's an important aspect to that as it relates to residential, which we'll get back to. But I was at First Solar for about a year and a half. Did a lot of DOE financing for some of the earliest projects, and then via a quick stint back in banking, ended up at Vivint Solar in 2013, where I was responsible for the capital planning and sort of raising the capital needed to finance the rapid growth that that company experienced from 2013, through 2020 when we sold the company to Sunrun. And what I did there was really take everything that I learned previously financing gas-fired power plants and wind, utility scale wind and utility scale solar, and apply it in the residential setting. So they're the same financial structures, and the only difference is really you're financing chunks of assets that are coming off of more of an assembly line kind of process as opposed to unique and very large identifiable projects. No one looks at every single residential project when they finance them.
Mhm.
And that's some of what we do at Clearlight, we try to do at Clearlight, using technology to make sure we're actually vetting as much as we possibly can. But in the past, financiers would typically spot check the assets to make sure that the documentation made sense, that the customer's actually saving money, et cetera, et cetera. But the financial structures themselves are effectively exactly what was used for utility scale, and that was really what I focused on. And then we sold the company to Sunrun, and I moved on. I spent 2 years at Posigen before starting Clearlight.
I feel like you talked a little bit about your motivation behind starting Clearlight and the sort of gap that you're trying to address by focusing on aligning the interests of the financing structures and the interests of the installers with that of the customer themselves. So I'd love you
Yeah.
to sort of double click on that a little bit.
Yeah, good question. I think if you're focused on generating a return on the capital invested in residential solar assets or any other asset, any other generating asset, if you're focused on making an investment and generating a return, there's a natural alignment with the customer, because typically power purchase arrangements entitle you to receive, payments for only what you produce. So what you're really focused on is the asset installed at a high level of quality, and will it perform as anticipated? And are you focused on providing the right maintenance to the asset so that it actually continues to perform for the life of it? And are you delivering to the customer? And so the reason I wanted to start Clearlight was because that focus on the asset and the asset return is very hard to sustain in a business where you've got competing interests. And what do I mean by that? In a vertically integrated residential business, particularly one that's publicly traded, there's a high degree of focus on growth and how many more megawatts am I installing. So it's very sales oriented. It's very much driven by a desire to just continue to install megawatts, and a lot of times it's hard to balance that objective with making sure that you're doing absolutely the most you can for the assets. And in some cases, well, I don't know to what degree this is pervasive, but there's always the potential risk that you're going to look at the assets and you're maybe not going to put in all the costs you think that asset might incur over the life, because if you understate those costs, it looks like they're generating more cash, and then you can raise more debt on those assets, and you can afford to pay more up front. So it becomes a little bit like a death cycle if you're not really vigilant and disciplined about that pricing process and making sure that you're actually doing everything you can to sort of return capital and a return on the invested capital. And in some of the bankruptcies you've seen in recent times, that was exactly one of the problems, right? Is that the topco, the entity that should be generating dividends and a cash flow stream off of the assets that they were investing in, was subsidizing the assets and just borrowing more money to pay for, for those subsidized amounts. And over the years that added up. And then you have a blip in the capital markets, or people look at the model and say, I'm not really sure I believe this anymore. And then the house of cards come in. So separating out those component parts, the sales and installation organization, the servicing organization, and then the asset ownership piece was really what I thought was needed in the residential industry. And given that my background is financing and owning assets, I used to cover developers. That is what I set out to do, to create a platform that did one thing and really focused on doing one thing really well. And by generating returns for our investors, my argument is that I'm doing the best I possibly can for the customers, because the customer does well, my investors will do well.
Can I ask, I mean, generally, Colin and I want this show to be optimistic.
Yes.
And this is a tough subject right now. So I'm wondering, at a time when we're seeing headlines where the big banks are hesitating with their tax equity investments right now in the renewable space, why do you think investors should remain optimistic about the renewable industry?
In general, or residential specifically?
I'd be interested in both, actually.
So that's actually a pretty easy one. In the 30 plus years I've been doing this, I've never seen demand growth like we're seeing right now. So between electrification and electric transportation and data center and AI demand growth, it's a brand new world. I used to always lament the fact that I was in an industry that sort of felt stagnant, because year over year, power demand went down through energy efficiency and deindustrialization. So you had years where power demand was going down, and I thought, I'm in a great business because I'm financing assets that nobody wants. Some of the gas plants that I financed in the late 90s ended up kind of being sold and then resold because no one knew, they're worth a lot of money today. But that's kind of the irony, or not the irony, but that's one of the aspects that people tend to forget. And it's also important on the residential finance side too. These assets last a long time. There's, all generation lasts a long time. Coal plants last 45, 50 years. Nukes even longer. Gas plants also 30 years, like so. So it's really a long-term investment. But all of this growth in demand, coupled with an aging transmission and distribution infrastructure, I think means it's unavoidable that rates, consumer rates, commercial rates, wholesale rates are going to go up a lot more than we've seen. And my personal view is that renewables have a role to play in satisfying that demand at the lowest cost possible. To me, I tell my boys and my nephews, like, you want a future, get into renewables, because it's not going away.
Yeah, I love to hear that, Thomas, because we agree, first of all, right? Demand is, the markets will drive outcomes when it comes to investment and when it comes to manufacturing and development and the growth of this industry. And that's true in the United States. How, like, when you step outside of the United States, that perspective, that demand for renewable energy is exponentially higher than even in the United States. So when you're thinking about how that translates to the finance industry, does that, like, how do you gauge and plan for Americans to get to the point where, oh wait, the whole world is so far ahead of us in terms of demanding this product, and these manufacturers are going to be able to export those products over time, even if Chinese products are cheaper right now. Like, how do you think about that?
So our first partner for Clearlight is Enfin, which is a part of Qcells Hanwha. So I had an opportunity to visit their new cell manufacturing and module assembly facility in Georgia, and I'd been on the SIA board when, pre-IRA, when there were lots of discussions around how do you incentivize domestic manufacturing. And so when I saw that, I thought all those years of discussion and hard work, and on the part of SIA, was paying off. And so to me, it was really exciting to see that. I don't know how to bring that message across more broadly, because we do face some skepticism in this country around renewables, which I find unfortunate. But to me, that represents energy independence as much as fracking does, right? I mean, the ability to every year pump out, 3 to 5 gigawatts of solar, energy manufacturing capacity. I mean, we're pretty far behind the Chinese, obviously. We got a lot of work to do, but to me, that's part of what is so exciting about what we're doing in renewables and solar specifically. There's no way it's not the future. And I think the rest of the world has figured it out, and I think we will get there eventually. And we may ebb and flow through policy ups and downs, but I think that the forward progress is unstoppable.
You're right.
I mean, I get
Right.
frustrated when I feel like people don't just immediately see that picture and buy into it wholesale. It's frustrating to me, but I'm not the PR person or the marketing person. I think that's your job.
85% of all new power added to the grid in the first 9 months of the Trump administration was solar and storage.
Yeah,
That's huge.
yeah,
And it's been that way quarter over quarter.
and it's pretty exciting. I mean, what's going on with battery technologies? I haven't looked at the PV efficiency roadmap in a long time, and to know where it's tapering out and how much improvement there still is in terms of just the productive capacity of or productive efficiency of solar panels. But it feels to me that batteries have a long ways to go, and there's a lot of technical innovation there, which is the solution to all the concerns that are, in part rightfully raised around the intermittency of solar. But there are solutions. So where there's a will, there's a way. I mean, we built the railroads, we built the highway system. I think we can figure this out.
Thomas, we would love to hear more about your Clearlight's business model. And actually, I'm particularly interested in how you're weaving residential storage into the residential solar products, and how you talk about that.
So we don't sell, we don't want to sell, and we don't want to service. We want to own the assets at a fair return, make an investment on that. And what we focus on is the upfront policies, making sure that our partners are enforcing sales policies, consumer compliance policies when it comes to sales and marketing materials. We're verifying milestones. So we're making sure that we're getting all the appropriate documentation. As an owner of the asset, we want to see as-built designs for future reference when we're servicing the asset. We actually even we're partnered with Anidian on the O&M side, so we run our systems through a performance verification test. All things which aren't typically done on the loan side, because a homeowner, like I said earlier, can't do a lot of that stuff. And we focus on doing this using technology. So it's very fast. We know that installers want to move through these milestones as quickly as possible, because that also creates the best consumer experience. So we do all that and we actually, because we're using technology, we're using machine learning. We're reading every single document, scraping the relevant the pertinent information we need, verifying that we have actually what we're buying and what we're investing in. So think of it as almost as a service on our own behalf, but also on the customer's behalf. And we think that's just something that's unique. In the past, I think In a lot of cases, a lot of that has been done manually, and it's slow, and there's a lot of mistakes made. And so we're kind of like almost like a clearinghouse in a way. But we really are focused on owning the assets and generating an investment return.
Mhm.
And like I said at the very outset, we think that makes us highly sort of aligned from an incentive basis with customers. Um, so we'll police the dealers and the installers, or at least our channel partners that we're working with, to make sure they're enforcing their policies, and then we'll go out and hire the best service providers from a billing and collections perspective and from an O&M perspective, and outsource that. If you think about it, when you have service entities that are embedded in big companies that are doing a lot of other things, that's another area where you potentially have a conflict. We will reserve the ability to basically let go any service provider we don't think is doing a good job.
Right. So
It
for
allows us
our
to act a little differently
Mhm.
than owners who are servicing their own assets.
Right. So the value proposition is you just have peace of mind. You have better quality return over time because you know that your system is going to continue to work, right?
Yeah, but it's more. I mean, it's more than that, because I think part of why I'm actually doing this, and we did a webinar a couple of weeks ago as well, is I think our financing is mystifying to people a little bit when it really doesn't have to. I'm trying to and maybe some of what I was explaining earlier doesn't help, but I'm trying to simplify it. Because I know there's concerns about the TPO product. I've heard some people in the marketplace, oh, the TPO product it's not a good product. But we're taking all the costs of ownership, um, and we're translating that into an investment value, which is a cost value. We're saying that's what we'll pay for the asset. And we're also enforcing a savings outcome to the customer. So we're capping what you can charge the customer. And I think that creates transparency and sort of rational pricing. What we do is, I don't know if you've ever heard of levelized cost of energy. It's what the utility companies do when they're looking at sort of different generating options. They look at what it costs to, what the upfront investment costs are, what all the long-term costs of operating the system, including fuel costs. They basically divide the cost by the output, and they say my levelized cost of energy is Y. What we do is we set that levelized cost of energy at a rate that saves the customer money, and then we back into an upfront investment amount. And when I calculate that number, I think in most regions, an efficient installer should be able to install for that price and generate a margin and cover their costs. The problem with the TPO product historically had been that the originators were driving, because they were buying volume, they were driving up the price of the asset to pay sales forces higher and higher commissions because they wanted to buy assets. The returns suffered, the asset returns suffered, and then they in part were using service organizations to subsidize that higher cost as well. It was just not a good, it was not a good mix. But I think a lot of that's worked its way through the system. You have to look at every TPO provider individually. And what we're doing is trying to provide a really rational sort of pricing that will defend with anybody, and create some transparency. And because at the end of the day, for better or worse, 25D is gone. And so what financing options does that leave us with? It really leaves us with the TPO product for the most part. And if people don't understand the product, that's a problem, because most people need some form of financing in order to get into residential solar. So I think it's an essential service to the industry to do what we're doing.
Before we let you go, you just alluded to the 25D disappearance. This is going to be an interesting year for the residential sector, as they all are, it seems. But what do you think is you already touched on the strong demand. Like I think that's clear that there's going to continue to be high demand for these systems and for this type of product. But do you think that we are in for any more sort of seismic shifts in the industry? What are your predictions and forecasts for 2026 when it comes to resi solar?
Well,
It's an easy question, I know.
the people who study this on a daily basis um, think that the market's going to be down, what, 25%. So I think 24 was I can't remember now the numbers off the top of my head. I think it was a 4.7 gigawatt year. So I think people think it's going to be just over 4 gigawatts this year, which is down, which is unfortunate. So volumes will be down. I am, I'm not, I think monetizing the tax benefits is going to be the biggest challenge for the industry. I know a lot of people are thinking about these prepaid structures as a substitute for 25D because it allows the homeowner to borrow the money in order to prepay for a PPA. I honestly, I don't fully understand why a customer would do that. I'm open to, open to having people explain it to me, but in my mind, if I've just signed a PPA, which comes with 25 years of service arrangements sort of embedded in the price, why would I give that up in year 5 to buy it for the value of power that I don't need for another, 20 years, from years 26 to 35? I put myself in the customer's shoes. That's what I always do. It's like, why would I do this? And so if it's being sold as a path to ownership, I'm not convinced. And that structure also requires tax equity. And it's almost a misnomer to call it tax equity these days because it's very difficult to find traditional tax equity where a bank will actually monetize depreciation and give you full value for the ITC. Even on balance sheet, a lot of these structures are sort of hybrid structures where they're giving you value for the depreciation, but the ITCs are just being sold via transfer anyway, and a lot of times you have to figure out how to do that yourself, or in not always, but it depends on who you're talking to. And so I just don't know that there's enough people around to actually finance that quantity of systems because if you assume that the prepay is going to step up and take over the volumes that in the past were financed with 25D, that more than doubles the amount of tax equity for residential and the amount of ITCs. And the tax credit buyer universe, they don't love residential. I mean, we're working hard to try to change that. They think there's higher recapture risk, which we always explain to them is not the case because it's highly unlikely that a huge portfolio of thousands of residential systems are all going to, cause recapture at the same time. It's more likely that a meteor will hit your solar plant, your utility scale solar plant, right? So, but for whatever reason, I think in part it's also all the noise around the business structure. So we're trying to educate people on how we're different than some of these vertically integrated businesses that went under. So there's a lot of work to be done there. And if I were to make a prediction, it's that piece is going to be the hardest piece to fill on the capital side.
So what's your advice to the industry right now? It feels like there is a lot of flux and there's a lot of change in how we are communicating to customers and how we are talking about these as long-term assets. Like what is your...
If you're a skeptic of TPO, let's have a conversation because I'd love the opportunity to convince you not to be, because I personally, I know not everyone agrees with me, but I personally think it's the best product if it's properly priced and you can explain to people like what you're doing. And find a reliable partner to work with. And one of the other complaints I've heard about TPO is it's too complicated, and that's the reason, because I think the reason for that is that loans were more lenient in terms of documentation, milestone verification. I think you could go through the installation process, to design, permitting, installation, the milestone process easier with the loan, or at least that was the perception. So that's part of what we're trying to work on as well, trying to make that as transparent and easy as possible as well. But if there's a complaint around that, my answer is, well, we're not being unreasonable. We're just asking for the sorts of things that a long-term owner of the asset should have, and you should be able to provide. So, but my suggestion is think a little bit more about TPO, what it actually means, what it means for the customer. Put yourself in the customer's shoes and think about what makes the most sense for most homeowners. And I think you'll come to the conclusion that TPO is a pretty good product, as long as you've got a good partner.
Can I ask one more question before we let him go?
Sure.
How do you feel about utility-owned DG?
No. The question is probably, how do I feel about utility rate making? Because I think we're in for like a whole world of confusion and pain and hurt when it comes to classical rate making. Because the world, when I started at Vivint, one of the things I was so excited about, having spent most of my career in utility scale, generation, is the ability to avoid the utilities, because interconnection queues and it's painful. It's painful. It's slow. And so I was excited about distributed distributed generation and distributed assets, because the technology is now allowing you to be modular and create little power plants on rooftops. And to me, so in my mind, the utilities should almost be like an insurance policy. It's like, I'll be there in the few instances where your solar system and your battery can't provide everything you need, right? And what's the right charge for that, as opposed to, I'm going to charge you this giant fixed charge and try to recover, years of investment in distribution, from you, little customer. So I don't know. I think it raises the same level of cost shifting questions that they've raised about net metering, right? It's like, oh, you're leaving the system, and so all the costs that I incurred to serve you, I'm now have to, peanut butter on the rest of the customers. And I think their ownership of DG raises the same issues in reverse. So my bigger concern for rate making is is utilities going out and signing these long-term contracts and doubling their generation capacity for an AI center. Like, how much AI business risk are they taking, and what happens if that system, who's going to be left holding the bag if that load goes away? Because I lived through New York State's stranded asset debacle in the 90s, when the Public Service Commission in New York required all the utilities to sign non-utility generator contracts at 6 cents kilowatt hour. And then they signed up so many contracts that they had all these stranded costs, right? And so I see the potential for, stranded cost risk here all over again. So between that and how to effectively promote DG, so I don't know if that's a real answer to your question. I'm skeptical. I'd be open to hear the arguments, but I'm skeptical of DG, utility on DG.
Thank you for answering the question. We've held you captive now for more than a half an hour. So
well, I love talking about this stuff. So
yeah, well, I really appreciate you taking the time, and the focus on the customer and how they sort of perceive these deals, I think is really valuable. I think we can get really caught up in all the the back and forth about what kinds of financing mechanisms we need and how to drive growth, and I think centering what we're doing in what an average person wants to hear and needs to know is really valuable. So
thank you. Agreed.
Thanks, Thomas. Talk soon.
Thank you, guys.